Hello, esteemed listeners and investors tuning into our Expert Insights podcast. I am Ryan Oliver, and today we will dissect a question that is troubling many. Does the current strong growth of financial markets truly reflect the health of the real economy? Or are we facing an illusion created by capital flows and expectations? Don't you see, while mainstream media headlines are filled with stories of strong recovery in U.S. stocks, Bitcoin surpassing the historic $100,000 mark, and gold approaching an unprecedented peak? A bright picture, isn't it? But is that the whole truth? We are witnessing a clear decoupling. On one side, financial markets are euphoric, and on the other, there are conflicting, even alarming signals from the real economy. So, what is the true driving force behind this surge? Are we entering a new cycle of monetary expansion, or is a wave of speculation overshadowing fundamental factors? In today's segment, with over 2 decades of experience in macroeconomic and financial analysis, I will delve deep with you into each layer of data, analyzing the underlying movements to find the answer. Let's start with the core of all markets, the monetary policy of the Federal Reserve, Fed. We've seen the Fed make very subtle moves in 2024 and early 2025. First, regarding quantitative tightening, QT. After reducing its balance sheet from nearly $9 trillion to $7.4 trillion by March 2024, the Fed significantly adjusted the pace of its balance sheet reduction. From $60 billion month, then $25 billion month, by March 19, 2025, the monthly cap for Treasury securities reduction sharply decreased from $25 billion to just $5 billion. This extreme slowdown suggests a near-complete end to the QT program. The Fed's stated reason is to allow banks and financial markets more time to adapt in order to reduce the potential for unwanted stresses in money markets. The ultimate goal remains ample reserves, estimated by some Fed officials and economists to be around $2.7 trillion to $3.4 trillion, or 10-12% of nominal GDP. As of January 2024, bank reserves were over $3.7 trillion, indicating room for further but more controlled contraction to avoid market shocks. This adjustment reflects the Fed's prioritization of market stability over quickly achieving a specific balance sheet size, suggesting a cautious shift in monetary strategy. Second is the interest rate outlook. The market, according to the CME FedWatch tool, is pricing in a 49.4% probability that the target rate will be in the 3.75%, 4.0% range by October 2025, and a 39.3% probability for the same range by December 2025. This implies 2 rate cuts in 2025. However, official statements from Chairman Jerome Powell remain very cautious, emphasizing data dependence, especially as the Fed anticipates inflation to rise to 3% by the end of 2025, partly due to tariff impacts. The divergence between market expectations and the Fed's stance creates a significant element of uncertainty. Finally, the supplemental leverage ratio, SLR adjustment. In June 2025, the Fed permanently exempted U.S. Treasury securities and reserves from SLR calculations. This move aims to remove a significant impediment that prevented banks from effectively participating in the $33 trillion Treasury market. During the 2020 pandemic, a temporary SLR exemption helped reduce Treasury market volatility by 25%. Treasury Secretary Scott Bessent even estimated that this reform could reduce 10-year Treasury yields by 30 to 70 basis points. This is a powerful technical move, freeing up capital for banks and facilitating their absorption of increasing government debt. This could reshape bond market dynamics and reduce long-term borrowing costs. Is this how the Fed is indirectly injecting liquidity into the system without calling it QE? Beyond the Fed's actions, the global macroeconomic picture shows alarming signs, starkly different from the optimistic narrative of mainstream media. The International Monetary Fund, IMF, has lowered its global growth forecast to 2.8% in 2025, a significant reduction from its previous 3.3% projection. This downgrade reflects the impact of escalating trade tensions and extremely high policy uncertainty. For the United States, growth is expected to slow to 1.8%, 0.9 percentage points lower than the January 2025 forecast, due to increased policy uncertainty, trade tensions, and weaker demand dynamics. Global inflation is also projected to decline at a slightly slower pace, reaching 4.3% in 2025. Regarding U.S. economic indicators, consumer spending is projected to increase by 2.3% YOY in 2025, indicating consumer resilience. However, the U.S. market manufacturing PMI in June 2025, while rising to 52.0, indicating expansion, saw input costs increase to their highest in 34 months, reflecting tariff pressures and raw material scarcity. The labor market also shows cracks. The May 2025 U.S. Bureau of Labor Statistics report showed a net gain of 139,000 non-farm payroll jobs, consistent with the average monthly increase, and the unemployment rate remained unchanged at 4.2%. However, downward revisions to March and April 2025 job figures, totaling 95,000 fewer jobs than previously reported, suggest the picture might not be as robust as initially perceived. We cannot overlook the profound impact of geopolitical shifts reshaping the world order and directly affecting the economy. First, the rise of BRICS Plus. With Nigeria, UAE, and Iran joining, BRICS Plus now accounts for a significant portion of global GDP and over half the world's population, positioning itself as a stronger alternative to Western-led financial institutions. A key driver of this expansion is the effort to reduce reliance on the US dollar. BRICS nations are actively increasing their gold reserves, signaling a shift towards commodity-backed assets and away from dollar-centric reserves. Furthermore, the creation of alternative payment systems like BRICS Pay illustrates efforts to establish financial infrastructure that bypasses traditional dollar-based systems, facilitating trade in local currencies. This trend, if it continues, could reduce demand for the US dollar, potentially leading to a weaker dollar value, higher import prices, and increased inflation in the United States. It could also require the Fed to maintain higher interest rates to attract capital and potentially lead to capital outflow if foreign investors shift away from U.S. assets. Second is the U.S.-China competition. The economic rivalry between the United States and China continues to reshape global trade and supply chains. The U.S. trade deficit with China, allegations of intellectual property theft, and China's strategic targeting of high-tech industries are reshaping global trade flows. Tariffs have increased U.S. consumer prices by approximately 0.5% annually and raised production costs by 10 to 30% for electronics and machinery dependent on cross-border components. This also contributes to inflationary pressure, adding about 1.2 percentage points to U.S. inflation in 2025, complicating the Fed's efforts to control prices. Finally, the Russia-China-Iran alliance has emerged as a significant tactical alignment driven by shared interests in limiting Western, particularly U.S., strategic dominance and promoting a multipolar global order. For Russia, Iran provides a valuable front to divert U.S. attention and resources from the Ukrainian battlefield. For China, Iran serves as a buffer against expanding U.S. presence in Central Asia and the Gulf, while securing crucial land-based energy routes vital to Beijing's economic and security interests. These three nations have intensified efforts to circumvent Western sanctions by developing alternative financial systems and logistics networks, including increased trade in yuan and rubles, and utilizing Caspian Sea routes. Despite strategic coordination, the relationship remains marked by underlying competition, suggesting the alliance is effective as leverage against U.S. dominance and a shield for economic survival under sanctions, but is inherently limited in strategic depth, shaped more by caution and pragmatism than deep solidarity or strategic alignment. The World Economic Forum, WEF's Global Risks Report 2025, also highlights an increasingly fragmented global landscape. Armed conflicts between states are identified as the #1 current risk in 2025, alongside geoeconomic confrontations, sanctions, tariffs, societal polarization, and extreme weather events. The report also warns about the risks of misinformation and disinformation generated by AI. These factors threaten global stability and the sustainability of supply chains. So, with such a complex macroeconomic and geopolitical landscape, what are the investment implications? Let's look at stock market valuations. The U.S. stock market has seen significant growth, but current valuations raise questions about the margin of safety for investors. As of May 2025, the S&P 500's PE10 Shiller-Cape ratio is 35.0, significantly higher than its historical average of 17.6. In fact, the current PE10 ratio is at the 99th percentile of its historical average, indicating an overvalued market. Although Q1 2025 S&P 500 earnings increased by plus 13%, largely driven by major AI companies, the outlook for the rest of the year remains cautious due to rising input costs and potentially diminishing demand. In this context, a contrarian perspective is essential. Be fearful when others are greedy, and greedy when others are fearful. This classic advice from Warren Buffett rings even truer in today's overvalued environment. Moving to alternative assets and diversification. Gold has seen a significant appreciation in 2025, rising 35% to reach $3,500 per ounce. This surge is driven by factors including the national debt exceeding $34 trillion in the U.S., the weakening trajectory of the U.S. dollar against major currencies, and ongoing geopolitical tensions. A crucial driver is central bank gold purchases. The World Gold Council's 2025 Central Bank Gold Reserve Survey shows that 95% of respondents believe global central bank gold reserves will increase in the next 12 months, and a record 43% expect their own gold reserves to rise. Key reasons for accumulating more gold include its performance during crises, its role in portfolio diversification, and its effectiveness as an inflation hedge. The trend of reducing reliance on the U.S. dollar is also a driving factor. The majority of central banks, 73%, anticipate a moderate or significant decrease in the U.S. dollar's share of global reserves over the next 5 years, expecting the proportion of other currencies like the euro and yuan, as well as gold, to increase. Gold has outperformed the S&P 500 by approximately 40% year-to-date in 2025 during peak trade tension periods. The proportion of gold in central bank reserves has increased from a global average of 15% in 2018 to 22% in 2025. This suggests that gold is increasingly viewed as a strategic asset and a portfolio protector in an uncertain world. Regarding Bitcoin, this asset also had a strong 2025, gaining 13% to reach a price of $104,770 by June 2025, nearing its all-time high of $112,000. This growth is fueled by a combination of reduced volatility and increasing institutional adoption. Historically, Bitcoin's volatility deterred institutional investors, but recent trends indicate a decrease in price swings, making it more attractive as a portfolio asset. The introduction of spot Bitcoin exchange-traded funds, ETFs, has transformed institutional access to Bitcoin, acting as a key catalyst for the asset's explosive adoption in 2025. By April 2025, spot Bitcoin ETFs had accumulated over $65 billion in assets under management, AUM, demonstrating pent-up demand from institutions previously hindered by regulatory or logistical barriers. Institutional inflows into Bitcoin ETFs increased by 10% to $500 million by June 13, 2025, pushing Bitcoin's price higher and contributing to its reduced volatility. Leading analysts project Bitcoin's potential in the range of $200,000 to $210,000 within the next 12 to 18 months. Bitcoin is also seen as an asset that can hedge against U.S. dollar weakness, similar to gold, as BRICS nations and investors seek to diversify away from traditional assets. Contrarian application. Diversifying into alternative assets like gold and Bitcoin is a suitable contrarian strategy in the current market environment. The Socratic model in investing encourages investors to expand their thinking to alternative investment ideas and solutions, often with a contrarian bent. It advocates for building a contrarian portfolio that actively seeks out and leverages market and economic cycles for long-term benefit, while avoiding the herd mentality that is often detrimental to most investors. In a market where traditional assets may be overvalued and face unprecedented geopolitical risks, allocating assets to areas often considered risky by the average investor, but well understood by the Socratic investor, can reduce overall risk through prudent diversification. This includes allocating to commodities, emerging markets, and cryptocurrencies as a hedge against dollar weakness and stock market instability, aligning with the principle of selling when strong and buying when weak. Amidst a flood of information, some misconceptions have become deeply ingrained in the minds of many investors, and we need to address them directly. First, the view that the Fed is printing money again. This statement is inaccurate. As we have analyzed, the Fed has not officially returned to large-scale quantitative easing, QE, programs. The slowdown in QT and technical adjustments to the SLR are aimed at maintaining money market stability, not large-scale money printing to stimulate the economy as seen during the pandemic. Second, every correction is a buying opportunity. This is a dangerous perspective. The market does not always recover in a V-shape. The credit cycle, current asset valuations, e.g. historically high PE10, and a macroeconomic environment full of risks need to be carefully considered. A correction in the context of a weakening real economy and overvaluation could be the beginning of a prolonged downtrend, not an opportunity to buy the dip. And finally, Warren Buffett holding cash is a mistake. This view often comes from short-term investors who do not understand his value investing philosophy and long-term perspective. With his immense capital base and economic cycle foresight, Buffett's accumulation of large cash reserves is a prudent strategy when he doesn't find fairly valued assets or is waiting for a downturn to buy at distressed prices. That is master-level risk management, not a mistake. So, esteemed listeners, after dissecting this data and these arguments, is the current market rally a sign of a new sustainable growth cycle, or merely a temporary effect of easing expectations that may never fully materialize as the market hopes? And a deeper question. When the Fed, or any central bank, faces the choice between price stability, that is, controlling inflation, and financial system stability, what will be their true priority? What has history shown us? Finally, if traditional currencies, especially the US dollar, continue to lose value amidst complex geopolitical landscapes, which assets will retain the trust of global investors? Gold, Bitcoin, or another asset we haven't yet identified? Please leave your comments on our podcast platforms or YouTube channel. We eagerly await your independent perspectives and will delve deeper into these topics in future segments. Thank you for listening to Expert Insights. If you found this content useful and wish to continue receiving in-depth, unbiased analysis of the global economy and finance, don't forget to subscribe and share our channel. See you next time.